Hi there, Doug Lindsay here with 10 slides in 10 minutes. Your financial questions answered in 10 minutes or less. Let's talk about how we use asset allocation to manage risk and reward in your investment portfolio. This chart shows the different kinds of assets most commonly purchased, with the most volatile being on top and the least volatile on the bottom. Investing in U.S. government bonds has lower risk and lower potential return than investing at the initial public offering of a Chinese internet stock. You can recognize volatility intuitively. For example, if I told you that you could earn 4% next year on U.S. government bonds or 4% on the Chinese internet stock, which would you choose? The safer U.S. bonds, right? Another thing to notice, the news media reports on the Dow's progress every day, but the Dow is just 30 stocks out of thousands and only represents the large cap stock asset class. If you're invested in an allocation of all of these assets, then your portfolio's rate of return is going to be different than what you hear on the news. There are three components or considerations in determining how we use asset allocation in our investment philosophy. The first component is the asset class rate of return. How much money has the asset class made over time? The second component, asset class volatility, is usually measured mathematically using standard deviation. How much does my portfolio go up and down? And the final component is the relationship of volatility between the asset classes, or correlation. Does one holding go up when another goes down? Let's look more closely at component number one, asset class rates of return. This chart from Ibbotson shows the return of four common asset classes plus inflation over the past 90 years. Inflation is the bottom line in gray, and $1 in 1925 grew to the equivalent of $13 now. That's an annualized average inflation rate of 3%. The next line in orange is Treasury bills at 3.5% over the same period. Next is long-term bonds in green at 5.5%. Large cap company stocks in purple at 10% growth per year. And finally, the top blue line represents small company stocks at 12% growth per year on average. So why don't we just buy small or large cap stocks and forget it? Because once we look at the returns on a shorter time horizon, the picture becomes less obvious. This chart shows the single-year returns since 1990 of a group of various assets. For example, notice in 2000 how commodities made 50%, but large cap stocks lost 10%. Now, fast forward to 2013, and the tables have turned where large cap stocks made 30% and commodities made nothing. In the short run, these various asset classes move unpredictably up and down. Now, let's look more closely at component number two, asset class volatility. This chart shows the distribution of returns by asset class from 1926 to now. Starting at the bottom, notice how U.S. Treasury bills in orange have a narrow band of return rates from just barely at 0 to maybe 6%, with an average of 3.4%. The 90 years of data for T-bills is spread across a very narrow range of returns, making the standard deviation or volatility very low also. If you were only invested in T-bills, you wouldn't make much money, but you'd have a very smooth ride. Now, notice small company stocks at the top in blue. Their average return is 12%, much higher than Treasury bills, but the range of returns goes from minus 60% in one year to plus 80% in a different year. This is why we don't just buy small company stocks. They are too volatile for most investors. So we add a little bit in our portfolios just to get some of that nice, juicy return. Now let's look at component number 3, relative volatility or correlation. How about an example to get at the meaning of correlation? Say you run a beachfront store in Florida. On warm, sunny days, you sell lots of ice-cold soda. Warm temperatures and soda sales are positively correlated. Soda sales and temperature move up and down together, and one predicts the other. On the other hand, on cold, rainy days, you sell lots of hot coffee. Warm temperatures and coffee sales have negative or weak correlation. As one goes up, the other goes down. And some products may not be related to temperature at all, like umbrellas. If it's rainy, customers buy umbrellas to stay dry. And when it is sunny, they buy umbrellas to provide shade. Your store can even out profits regardless of the weather by carrying all of these products: soda, coffee, and umbrellas. Let's put it all together. Asset classes work the same way as the soda, coffee, and umbrellas in your Florida beach store. Some have strong linear relationships, positive correlation. Others don't move together so much, weak or negative correlation. And some don't seem to be related at all. Buying some of each asset class helps your portfolio perform more evenly in all kinds of weather, rain or shine. Let's look at the potential benefits of diversification. This chart shows risk across the bottom, greater risk to the right, and return up the left side, more return at the top. Start with the purple curve labeled large cap stocks and bonds. The bottom left edge of the purple line represents 100% bonds. Midway up the line is 50% bond, 50% stocks, and the far right edge of the line is 100% stocks. Notice that return and risk generally increase with more stocks, but this line is not straight. 100% bonds can be made less risky and provide better returns by adding some stock to the mix. Depending on where you start on the purple line, some changes can increase returns without adding risk. For example, in a portfolio with mostly large cap stocks, adding the assets represented by the green line, which includes small cap stocks, and foreign bonds, increases return without increasing risk. And if you start closer to 50-50 large cap stocks and bonds, adding the extra assets of the green line reduces risk or volatility without decreasing the return. Finally, some changes, like adding commodities, can both increase return and reduce risk. This busy-looking chart is called the periodic table, or an investment quilt. Each colored box represents a different asset class. Each column represents a year, and the asset classes are sorted by best performer on top to worst performer that year on bottom. Take the red box, which represents real estate. Notice how in 2004, 5, and 6 it was at the top of the charts, but in 2007 it was at the bottom. Since it is impossible to predict where each of these asset classes is going to end up each year, the safe route through this mess is down the middle. This yellow box represents a mix of all of the asset classes, with 65% in equities and 35% in bonds. This is the heart of our investment philosophy and a very common asset allocation that we use with our clients. It helps us avoid the ups and downs of investing in any particular asset class. This final slide demonstrates the risk versus return trade-off that we must help our clients make when positioning their portfolios. The column on the left shows 3 different mixes of stocks and bonds. The middle column shows the return of each of these portfolios during the 2000 bear market. Notice that the 80% stock portfolio lost over 34%, while a 50-50 only lost about 14%, and a 20% stock portfolio, 80% bonds, gained over 6%. In bad times, bonds can be good for your portfolio. The last column shows a hypothetical total return over a 10-year period with average rates of return for stocks and bonds. Notice how much more money a high stock portfolio might make versus a low stock portfolio. Of course, this last column is just an illustration. None of us can predict the future. So for each asset allocation decision, there is no exact right answer. As best as we can, we have to match our desire for return with our ability to stomach the associated risk. We can help you do this. Don't hesitate to call us with questions about asset allocation or anything else financial. That's the end of this session of 10 slides in 10 minutes. Hope you enjoyed it. I'm your host, Doug Lindsay. If you need additional information, remember to go to our website, and please tune in to our next session. As always, contact us if you have questions.